What's up, everyone? It's Channing, and we are back at it with another live class today. We're going to be talking all about interest rates because interest rates are all the rage right now, right? That's what everyone wants to know about. What are interest rates doing and all of that good stuff. So what I want to do today is actually give a little small masterclass on mortgage interest rates and how they're calculated, what they affect, the different types, how to get the best one, as well as if you stay tuned until the end of this class, we're going to discuss how to avoid some of the shady tactics that lenders will try to use to trick you, which will end up costing you thousands of dollars. So you don't want to miss that. You don't want to miss out on everything that we have in store today. So for those of you that join in live, thank you. For those of you that come in later, also thank you. I look forward to jumping in right into this. And so what we're going to talk about today, like I said, is mortgage interest rates. We're talking about mortgage interest rates. We're talking about what they are and how they affect your home buying experience. So let's discuss really quickly, what is a mortgage interest rate? What is it? Why do we, how does this work? So with a mortgage interest rate, it's basically the cost of borrowing for a loan. And so money is not free. And so if you were to lend your friend $100 and you would say, hey, pay me $105 back because I lent you $100, that is the idea of what an interest rate is, of what mortgage interest rate is. Now, the thing is, they're a little more complicated because there are a lot of different rates. There are a lot of different terms. There are a lot of different products. And so within each of those, you're going to get a different rate, a different term, and it's going to affect your mortgage payment. It's going to affect how much you have to pay back at the end of that loan term. And so when we're talking about mortgage interest rates, what's really important to understand is that the higher the rate, the more it's going to cost you to borrow money. The lower the rate, the less it's going to cost you to borrow money. But the other side of it is that the shorter the term, the less the rate affects the cost of the loan. And the longer the term, the more the rate impacts the cost of the loan. So when you look at something like a mortgage, where you have a couple of different options, 15 years and 30 years being the primary ones that most people are utilizing, what happens is, with a 15-year mortgage, they're going to cost less than a 30-year mortgage. And it's not just about the interest rate, it's about how long that loan has been stretched out. And so the longer that the loan is stretched out, the more you're typically going to pay for that mortgage. And so when we're talking about interest rates, it's really important to understand that. Now, there's also a couple of different types of interest rates. There are fixed rates, right? And there are adjustable rates. So you have fixed rates, you have adjustable rates. Well, fixed rates are easy. Let's talk about those first. What is a fixed rate mortgage? Fixed rate mortgage is a mortgage that is fixed, right? It's a simple concept. So when you enter into that loan, it is fixed for a certain period of time, usually 10, 15, 20, or 30 years. And what that does is a fixed rate mortgage is going to offer you, the borrower, stability and predictability. How is it going to do that? Well, because the rate's not going to change. So when you purchase a home and you get a fixed rate mortgage, which is the most popular version of this thing, then your mortgage payment will not change. Now, understanding that things like property taxes and insurance, if they're in your mortgage payment, those can change, but the amount that you're paying back to the bank every single month is not going to change. They do not change. They will not. It will not go up if you're in a fixed rate mortgage. And so what that does is it creates predictability to you, the borrower, to know exactly how much you're going to have to pay back each month. And it allows you to budget easier. It allows you to know exactly what you need to include every month to make sure that you make your mortgage payment. And so that's stability and predictability. It also protects you from rate increases. So if you entered into an adjustable rate mortgage or a balloon type mortgage, then every so often, and we're going to jump into those here in a second, but every so often, your rate is going to be at risk of increasing. And so with a fixed rate mortgage, you're protected from rate increases, but you're also not given rate decreases. And I'll tell you that it isn't often that you get that anyways. And then finally, the fixed rate mortgage is going to give you peace of mind. And so one of the mistakes that people make is they try to find not a mistake. It's human nature. We want to find the lowest cost mortgage. But when we talk about adjustable rate mortgages, if you enter into the lower cost mortgage and it's an adjustable rate mortgage, and you based your budget on what the rate was fixed at, and then it goes up, it can blow up your budget. So fixed rate mortgages are going to give you peace of mind to allow you to know that you don't have to worry about that payment going up or that payment increasing, at least in terms of the amount that you're going to have to pay back to the bank. Now, adjustable rate mortgages are quite a bit different. Now, they're not as popular as they were before 2008. There's been a lot of reforms made to the adjustable rate mortgage, and that's probably one of the reasons why they're not as popular. So what is an adjustable rate mortgage? Well, it's just like it sounds. We call them ARMs for short, adjustable rate mortgage, ARM. We call them ARMs for short, and an adjustable rate mortgage has an initial fixed period, just like a fixed rate mortgage, except that period is not as long. And then after the initial fixed rate period, it's going to adjust. It's going to adjust most typically annually, but I've seen some with 6 months. And so whatever that adjustment period is, they're going to reassess that loan, and your rate will either increase or decrease. And most of the time it's increasing, not decreasing. So, and I hope that didn't cut off. No, we're good. So how do adjustable rate mortgages work? So for an adjustable rate mortgage, let's do this. For an adjustable rate mortgage, it's fixed for a period of time. That time period is usually 3, 5, 7, or 10 years. So what that means is when you enter into an adjustable rate mortgage, you're going to have a fixed locked in loan for a certain period of time. Once that time period is up, whether it's 3, 5, 7, or 10 years, the interest rate is going to adjust. And the adjustment is typically based on the LIBOR, or the London Interbank Offered Rate. And that's going to determine what rate you go up. Now, there are some other factors that you need to consider when considering these ARMs, or these adjustable rate mortgages. One of them being, what is the adjustment period? So when you enter into one of these loan programs or one of these mortgages, if you're going to enter into an adjustable rate mortgage, you need to understand what the adjustment period is. Namely, how long is the rate fixed for? If it's fixed for 3 years, if it's fixed for 5, 7, 10 years, whatever the fixed period is, you need to know that going into it so that you can plan accordingly, because you want to look into maybe getting a fixed rate or refinancing or doing something before that adjustment occurs if rates are increasing. The other thing you want to look at is, what are the loan's caps and limits? So because of some of the reforms that have happened within 2008 and Dodd-Frank and all these different things that came out, there are now caps and limits to what the rate can adjust to. and it may be 1% on year one, all the way up to a max of 5%. It could be 2 to 5% on year one to a max of 5%. There's going to be a cap in how much your interest rate can adjust, and you need to understand that, because if you were someone who took an adjustable rate mortgage in 2020 to try to get the absolute, I don't know many people who did that, but if you did do that, and you just to try to get the lowest rate, right? Then if you're adjusting now in 2023, where rates are now almost 7%, you would go up 4%, right? You would go up that much. And so your payment would double, triple maybe, because of the adjustable rate mortgages. So understanding what caps and limits, if you are in an adjustable rate mortgage, is critically important when getting an adjustable rate mortgage. Now, I'm going to be honest with you guys. I do not like adjustable rate mortgages, and we do not see a ton of them anymore. Now, with the rate increase that has recently happened, they have kind of become more of a popular subject because rates are elevated. But even now, we are not seeing that adjustable rates are as competitive as or offering anything lower than fixed rate mortgages. And there may be some credit union out there that's doing it because they're lending their own money. But as a general rule of thumb, the adjustable rate is the same as the fixed rate. And so there just it just doesn't make a ton of sense to enter into an adjustable rate mortgage at this time. And so adjustable rate mortgages, guys, are basically gambling. It's basically gambling. And that's one of the reasons why I don't care for them much, because you do not know what the future is going to hold. And no one knows if we're going to see 7% rates for 3 years, if they're going to drop to 4% in a year. Many people are claiming that. Many people claimed that right now in the summer rates would drop, and they actually went up. People are still claiming they're going to drop in the fall. But the reality of the situation is that we do not know what rates are going to do. We don't. There are so many factors, we're going to talk about them, that go into determining what an interest rate is and what interest rate you get. But the point of the matter is that we don't know. And so if you promise someone, hey, just buy this house now, even though you can barely afford it and you can refinance later, that's going to be detrimental to them, because we don't know. And what happens if rates stay this way for 5 years? What happens if they enter into an adjustable rate and rates go up to 10% and they were barely making the payment at 7% adjustable rate? There's just so much that goes into it that we don't typically recommend adjustable rates for that reason. So, let me go here. So now we're going to talk about interest rates, which I misspelled. Now we're going to talk about interest rates versus APR. Interest rates versus APR. We hear this a lot, right? What is my interest rate? What is my APR? Let's jump in and talk about the difference between the two. So your interest rate is going to provide you a clear picture of the cost of borrowing. That's what we just talked about, right? When we did this introduction to what are interest rates, that's what we just said. Interest rates are going to provide you with a clear picture of the cost of borrowing. They're going to provide you with a clear picture of the cost of borrowing. They're going to determine how much you're going to pay over the life of the loan, and this is predominantly factored in with your mortgage payment. Annual percentage rate, or APR for short, isn't just providing you a cost of the loan. It's providing you a view, or it's attempting to provide you a view of the total loan costs. So this doesn't just include your interest rate, but also the total cost of the loan. What do you mean, Channing? Well, what the APR attempts to do is to take in all of the fees of the loan, including the interest rate, including the amount you're borrowing, and give you a percentage based on that. And so you could have a rate of 5% and an APR of 6.5%. And so the goal of APR is to try to help you, within a quick glance, determine side by side which loan, if you're shopping mortgages between lenders, is going to have the best terms overall. The problem is that not all fees are calculated into the APR, and lenders have learned to adjust or change the name of fees or move fees around in order to show that their APR is lower or higher, mostly lower than it actually is. And so while it is a good concept, APR isn't a fail-safe. It's not a foolproof way to determine what you can and cannot do. There are going to be things that people can do, that lenders can move around to make the APR look appealing. And let's say you're comparing a conventional loan with one lender and another lender is doing an FHA loan. Well, the APR is going to be higher on an FHA loan because there are financed in funding fees that conventional loans don't have. So there's all these different things. The best thing that you can do if you're trying to compare loan costs is to actually compare the loan costs. And I've got another class that we did just like this one today on closing costs and how to look at them and how to determine who's actually giving you the best mortgage, who's actually giving you the best rate. And so I would encourage you to check that out if that's something that you are interested in. But that is the difference between interest rate and APR. Interest rate is trying to determine the cost of borrowing. APR is trying to determine the total cost of the loan over the life of the loan. So what we're going to talk about is what determines your interest rate. You want to know, how is my interest rate determined? How do I get a 6.5% and some other person gets a 6%, or I get a 6% and some other person gets a 7%? Well, let's look at that. Let's see what that looks like, right? Let's take a look and see what's happening with interest rates. What determines your interest rate? So right off the bat, number one, credit score and history are going to determine your interest rate. What's your credit score? How have you repaid your debts? That's going to be a huge factor in determining what interest rate you receive. Loan to value is another one. What is loan to value, Channing? Loan to value is the percentage of the purchase price divided into the loan amount. So let's say you borrow, you get a loan and you put 5% down. Your loan to value is 95%, right? Technically speaking, the lower your LTV, the better your interest rate's going to be. The lower your LTV, the better your interest rate's going to be, because the less money that the lender gives you on the property's value, the less risk it is for the lender. So if they give you, if you put 5% down, you're less risky than 0% down. If you put 25% down, you're less risky than all of them. And if you were to default on the loan, the chances of the lender losing money become less. So that is one of the factors that determines your interest rate. Also, your debt to income ratio, not a huge factor, but it does play, especially in things like PMI. So your debt to income ratio, again, I've done videos on this in the channel. You can go check it out, is your monthly debts divided into your monthly gross income. The lower your DTI, theoretically, the more loan options you have available to you, and potentially the lower your interest rate. The higher your DTI, you could see higher interest rates. Loan term is another one. A 15-year mortgage is going to have a lower interest rate than a 30-year mortgage. Now, you traditionally have 10, 15, 20, 25, and 30-year mortgages. The 30, 25, and 20 are all going to track close to the same. The 10 and the 15 are going to track close to the same in interest rates. There may be a small minor difference, but for the most part, they're going to track the same. Also, your loan type. Your loan type is going to play a role in your interest rate. Right now, for a lot of borrowers, FHA loan rates, mortgage rates, are significantly lower than conventional rates. And so even with the added costs of FHA's PMI, they are still cheaper for a lot of people right now. So what loan program you use is going to determine your interest rate. And then, of course, the big one is market conditions, right? In 2020, we were looking at 2 and 3% rates. In 2023, we are looking at 7 and 6% rates. The only thing that's changed is the market conditions, things like inflation, things like, the debt ceiling. All these different factors play a role into the mortgage rates that we're seeing. And so what a lot of people who are predicting what mortgage rates are going to do, those people are doing it based on what they see in the market conditions. And they're trying to determine, based on market conditions, here's what those interest rates are going to do. Most of them, if not all of them, are failing because it's a very, very volatile market. And so those are the factors that determine your interest rate. You want to get a better rate. We're going to talk about that next, but those are the factors that determine your interest rate. Hey, if you like what I'm talking about here and you appreciate the content in this video and you're a first-time home buyer and you're thinking about buying a house and you want to see what you qualify for, if you click that link down there, the bayoumortgage.com, bayou-mortgage.com, it will take you to our website where you can take a home buyer quiz and determine exactly how much you qualify for and what loan program you qualify for. And we'd love to talk to you. We'd love to put that plan together for you. We have tons of content available on the website, first-time home buyer classes. We have tons of content answering all of the most common questions that people just like you answer or ask rather, and we answer them. So if that's something you're interested in, please check us out. And if you love this video, please like it, please share it, and please drop a comment. I would love to hear from you. I would love to hear from you. All right, moving on. How does your interest rate affect your mortgage? Well, we just kind of talked about it, but let's jump in. Number one, it affects the cost of borrowing money, right? And this is a big one. You borrow $300,000 at a 7% interest rate, you pay back $750,000. And I'm just throwing a number out there. I don't know what it would actually be, right? You borrow $300,000 with a 3% interest rate, you pay back $600,000, right? Your interest rate is going to determine how much it costs you to borrow to purchase whatever it is you're purchasing. And what we're talking about mortgage. Your interest rate is going to affect your monthly mortgage payment. The lower your interest rate, the lower your monthly mortgage payment. And so a small difference in interest rate can affect the next one, affordability and your home buying power. If you got a 1% lower rate with a different lender, you might be able to afford $100,000 more or $50,000 more on a home than you could with the higher rate lender. So it's going to affect your cost of borrowing, which is going to affect your monthly mortgage payment, which is going to affect how much you can afford and how much your home buying power is. And then lastly, it's going to affect your refinancing opportunities. If you did a mortgage at 5% at the beginning of the year, they're now 7%. You're not refinancing, right? And one that I didn't include, it may even affect whether or not you sell your home, right? We're in kind of like a reverse housing crisis right now, where instead of people selling or losing their homes, they're holding on to their homes because they have 2 and 3% interest rates, which is smart. That's what people would do. And so people aren't listing their homes because of the low interest rates. They'd rather add on or just deal with it than actually move up and get into a different home. So these things all work together. Now, let's talk about how to get a great interest rate. That's what we're going to address. How to get a great interest rate. You want to know, how do I get the best interest rate? How do I improve my chances? How do I get the best interest rate that I can possibly get for me? Well, let's talk about it. Let's talk about it. The first and foremost thing is improve your credit score, right? 9 times out of 10, the better your score is, the better your rate's going to be. If you've got a 580, you're going to see a 7+% rate and you're going to have to pay for it. In this market, right? This is 2023 when we're recording. For those of you who may be watching in the future, hello, welcome. Right? If you have a 700 credit scoring, maybe your rate's 6.5, maybe your rate's 6.25. So the first and foremost thing, if you want to get a great interest rate, focus on improving your credit score to the best that it can be. With that being said, if you have a 640 or a 660 and you're going to get an FHA loan, or you're going to get a VA loan, or you're going to get a USDA loan, you're going to see a really great interest rate. Now, you're not going to probably see a great interest rate with a conventional loan, right? Because you're a 640 or a 660. You need to be a 740 or a 760 to see a really great interest rate with a conventional loan. But if you're going to utilize one of those loan programs, you're going to see a good rate. Now, of course, if you got to 700, it might get better. But the margin, it gets marginally better as your score goes up. So a lot of people mistakenly think that, oh, my credit's a 660, my credit's a 640, I'll never get a good rate. I got to wait until I get into the 700s. Well, it depends. It really depends. Most of the time, you're going to get FHA or USDA or VA if you're a veteran, and it's really not going to make that much of a difference. Secondly, save for a larger down payment, right? A lot of this is based on conventional loans. If you're going to get a conventional loan, the bigger your down payment, the better your rate's going to be. On FHA and USDA, it doesn't matter. USDA, you can't even have a down payment. But on a conventional loan, it definitely matters. So those are two. But here's the biggest one, okay? Here's the biggest one. And I think the statistic is something like 70+% of people utilize the first mortgage lender that they speak with. And that's mind-blowing, because that means we're not shopping. That means we're not comparing interest rates. We're not comparing fees. We're not looking out for, hey, maybe this lender has something that this lender doesn't offer. Unless they tell us no or things go wrong. And that's a lot of the business that we get, is people get told no or someone screws up and then we have to come in and fix it. But if you would shop for your mortgage, you would be astonished at the difference between lenders. You would be astonished at the difference in closing cost and monthly payment and interest rate between lenders. It is one of the best ways to get a great mortgage rate. And statistically speaking, data came out last year that those who worked with a mortgage broker saved on average $8,200 on their mortgage. Stay tuned to the end, because I'm going to tell you how to outsmart some of these shady lender tricks that one of the biggest lenders in the country uses to convince you that it's not that big of a deal. So stay tuned if you're interested in that. Next, you can shorten your loan term. Like we talked about, a 15-year mortgage is going to have a lower rate than a 30-year mortgage. And so it's also going to have a higher payment, right? So it's all about your tolerance for risk and what you can handle. I know Dave Ramsey preaches never do anything other than a 15-year mortgage. The reality is that there are very, very few people that can afford a 15-year mortgage. Most of the time when you're seeing 15-year mortgage, these are people that are refinancing from a home that they've owned for a while. And the cost of renting is still there. So if you're saving for a 15-year until you can afford a 15-year, that entire time you're also paying rent. And that rent money needs to be factored into your calculation on if it's worth it or not. And then lastly, you got to watch out for points and fees. If you want to get a great rate, you got to watch out for points and fees. I talk about this a lot in my closing cost video, but it's true. And so mortgage rates do not exist in a vacuum. So I can tell you that I can give you a 4.5% rate, and some other mortgage company can tell you that they can give you a 4.25% interest rate. But the reality of the situation is that rate exists, but it's going to cost you thousands of dollars, $20,000 maybe, right? And those fees are known as points and fees. Those fees are known as points and fees. And so you got to watch out for them, because just because you're quoted a low rate doesn't mean it's a better deal. One lender might quote you 6.5 and it not have any points and fees. And another lender might quote you 6 and it's got thousands of dollars in points and fees. Well, the lender that quotes you 6.5 could probably do the same thing. They were just realizing for you or looking out for your wallet, right? And maybe they send you both. And maybe you don't care and you want to pay the points. Well, give lender B a shot to put the points and fees in there and see how it goes. Again, this goes back to shopping for your mortgage. A lot of people don't want to do it because it's work and you got to talk to a mortgage person and their salespeople and yada, yada, yada. But the reality of the situation is you're going to save money if you shop for a mortgage. You're going to get a better rate if you shop for your mortgage. So that is how to get a great rate. You want to get a great interest rate? Do those things, work on those things. But ultimately, more importantly than all that, just talk to an expert, right? If you don't have a reputation, or not a reputation, but a trust with your loan officer, then find someone that you do trust and listen to their advice, but then shop, right? Trust but verify. If they tell you, hey, this is what it is, then take that and go shop it with someone else and see if that's really what it is. That's the best way to see what you're available for. And again, I'd love to help you do that. If you just click that link below, we can actually show you what your options are, how much it's going to cost, how much you're going to need, what your interest rate is going to look like, all of that good stuff. So we have reached the end, friends. We're going to watch out for these shady lender tactics. Now, you probably got some of this from the rest of the video, but you need to watch out for these shady lender tactics. I see it too often One is that they're going to quote you that low rate, but they're not going to tell you the fees involved. And the Sprocket mortgage is the one that does this the most. Those sprockets, man, they're intense. So they're going to quote you a low rate, and they're not going to tell you the fees. They'll say, yeah, we'll get you 5.75. And then you get your loan estimate and it's $14,000 in points. And you're like, well, I don't have $14,000. I'm like, oh, no problem. Since you don't have $14,000, we'll give you a 7.5% interest rate. You have to watch out for these tricks. I'm not just saying that because I'm a lender. I would tell my own mother this, my own brothers this. You got to watch out. One of the things that a lot of these call center lenders do, and I have the scripts, so I literally have receipts. I could prove this. Is they have scripting. This is number 2, telling you that all lenders are the same. They have scripting that's designed to convince you that shopping for a mortgage isn't worth your time, that the most you're going to save is $5 or $10 a month. And if you do that, you're going to miss your closing date. That's dirty, y'all. Because the reality of the situation is, I know I say that a lot, it's a lot more than $5 or $10 a month. If someone's at 7.5 and you get 6.5, that's hundreds of dollars a month, at least 100, depending on your loan amount. And then you want to do that math over 30 years and what you would save in interest. It's a lot. It's a ton. It's thousands of dollars. The report says on average, people saved $8,200 when they worked with a mortgage broker. So you got to watch out for this. When someone tells you, hey, what's more important to you, closing on time or getting a great rate? They're both important. Do I want to close on time? Absolutely. It makes things way easier and way less stressful. But it's a false dichotomy. I can have both. You can have both. You can close on time and get a great rate. And furthermore, even if it wasn't the case, right? And it is, but even if it wasn't the case, you got to weigh out. Do you want to wait an extra week potentially while you shop lenders and change lenders to save thousands of dollars over the life of the loan? I don't know. Maybe you don't. Maybe you don't care. Maybe it's just money and you'll make more of it. But I would care. And then the third one leading into that, right, is inaccurate closing costs. And unfortunately, we see this from all lenders, not just call centers, local lender, doesn't matter, right? If they know that they're competing against another lender, what they will often do is make their closing costs appear to be lower. But only box A really matters. So when you're looking at a loan estimate, it's only the lender's fees that really matter. If they have a cheaper title company, cheaper insurance, cheaper property taxes, then it doesn't matter. You can get those if they're real with a different lender. Only the lender fees matter. But what they'll do is they'll put $1,000 a year for insurance in a house that's in South Louisiana, where the insurance is going to be a minimum of $3,000 a year or $2,000 a year, and it makes the closing costs look cheaper. These are all tricks. These are all tactics that we don't do, that we refuse to do, because it's shady. It's downright shady, and they prey on the fact that you don't know what's going on. Furthermore, they're not spending time to educate you, to teach you on these things so that you can secure these things for yourself, so that you can protect yourself. So you got to watch out for these shady tactics. If you're a first-time home buyer, you need to be aware of these. You need to watch out for this because they are real and they happen, and you may not even know that that's what's going on. You might not know. So that is your guide to interest rates explained. Thank you for those who checked this out. Thank you for those who watched it. Really, really appreciate it. As a reminder, go down to the link, bayou-mortgage.com. Go to the website, read about different things, get your questions answered, and most importantly, check out our Homebuyer quiz. See what you qualify for. If you're a first-time home buyer and you want to buy a house in the next 12 to 0 months, 0 to 12 months, you want to know. You want to see exactly what you can qualify for, and it is worth a conversation to learn about your options. It's not a salesy thing. It's about understanding what you're trying to do and letting you know what those options look like, right? And you can cut the time in half by just talking to someone versus spending tons of time on YouTube, on the internet, trying to figure it out on your own. Then when you go watch the videos, you'll have a frame of reference and a base of knowledge to know, hey, yeah, that actually sounds right, or that doesn't sound right. So go to the website, give us a call. We would love to help you see what you qualify for. So I'm Channing. Thank you so much for tuning into this video, and I will see y'all next week.